Good afternoon, everyone, and thank you for joining us for the Charlotte Airport 3 Portfolio Live webinar and Q&A session with CrowdStreet. My name is Andrea Gonzalez. I'm an Investor Relations Manager here at CrowdStreet, and I am pleased to have Edward Griffin, Andrew Montgomery, Fred Hain, and Kevin Ellis from Griffin Partners on today's call to discuss their offering on the CrowdStreet Marketplace. After the short presentation, we will open up today's call for questions. At this time, all participants are in listen-only mode. So if you have a question during the presentation for the Q&A portion, please type it into the questions box and we will ask it on your behalf. And with that, I will turn it over to the Griffin team.
Thank you very much, Andrea. This is Edward Griffin. I'm the CEO of Griffin Partners. We're very pleased today to be able to present to you our offering for the Charlotte Airport 3 portfolio. We're grateful that you've expressed an interest and have joined us on this webinar. This is Griffin's fourth investment in North Carolina and our first investment in Charlotte. It's a market that we have been searching for investment opportunities in for over 3 years. We're very excited about this particular opportunity. It's actually one that we first became aware of almost a year ago and patiently waited while the opportunity matured and came back to us actually fairly recently. And with that, I'm going to turn it over to Andrew Montgomery, who is the head of our acquisitions group, and he's going to give you a little bit more information about the overall deal.
Thanks, Edward. Andrea, if you could scroll to the top of the screen, to the top of the investment page.
A little bit
further. There you go, just to the very top. Thank you. Thank you all for joining. As Edward mentioned, we're excited about this opportunity. This is our fifth offering through the CrowdStreet platform. And I am going to give a brief summary of the Charlotte Airport 3 portfolio investment and go through a couple of key points, and then I'm going to turn it over to Fred Hain to discuss the building specifics and returns, and then we can open it up for questions. So with that, as I mentioned, Griffin Partners, I guess, is a repeat and tenured investor as you are operator investor on the website, CrowdStreet's website here. You can see at the top of the page, we currently have about $600 million under management, about 4.5 million square feet of office product under our current preview, and we're growing, which is great, and we're excited about our investment here in Charlotte. To talk a little bit more about the project itself, if you could scroll down just a little bit to the key deal points. Well, just slightly up. This is a 3-building portfolio. It's 198,000 square feet between 3 buildings, two multi-story buildings and one single-story building. They're currently 85% leased. The transaction size is roughly $17.75 million at around $90 a foot. And our targeted investor IRR is about just over 20%. And the projects were delivered from 1981 to 1985. And a lot of improvements have occurred since the time of new ownership several years ago, and these are Class B assets with A amenities, if you will, for tenant finishes. So talking about the key deal points, there's obviously a value-add opportunity representative of our back-ended IRR residual value of over 20%. We think there's a mark-to-market opportunity for improving rents in the overall Charlotte market, in particular the airport submarket. And then obviously a replacement opportunity to purchase at below replacement cost at a roughly $90 a foot blended across the portfolio, which is a steep discount to replacement. The path of growth, which I'll touch on in a minute, the transforming airport market, which I'll touch on in a minute. As I mentioned, this is a repeat investment platform for us with Griffin Partners through CrowdStreet. This investment is through our Griffin Partners Office Fund 3. We're committing approximately $3.35 million to this offering. We're not offering any carried interest on our behalf, no acquisition fee, no disposition fee, no catch-up or promoted interest by Griffin. We're simply charging a 1% asset management fee to the CrowdStreet investors. Moving on to in the path of growth, section, as well as transforming airport submarket. As Edward mentioned, the Charlotte market has seen explosive growth over the last 20 years in terms of population and employment growth. The size has essentially doubled to 2.5 million square feet, about 1 million new entrants into the population since 2004. If you want to scroll down to more detail, this is under the location section called Asset Class Market that details at length various paragraphs about Charlotte and its performance in the office market. Charlotte has been an area that shows low cost of living, a high quality of life, and due to that, a number of corporate headquarters, including banking and financial institutions such as B of A, Bank of America, Wells Fargo, as well as other corporate users such as the home improvement store Lowe's is a corporate headquarters, Duke Energy, Family Dollar, amongst a few. The total office market is about 125 million square feet. The airport submarket is a fairly large market of 13.5 million feet, and we've seen continued positive absorption in the overall Charlotte market for the last 5 years, exceeding pre-recession level historical occupancy as well as rent growth. Obviously, due to this equilibrium in the market, we've seen a fair amount of new construction, which has not been able to outstrip the overall demand in the product type for office. We've seen 20 quarters or 5 years of positive absorption and rent growth across Charlotte. In particular, a third party that we rely on and a lot of our participants rely on is CBRE's forecast for real estate fundamentals. And in 2019, they're projecting overall positive absorption of 19 to be double that of the total of 17 and 18 combined. So we see a positive path of continued growth because of the quality of life, the low cost of doing business, et cetera. There is new supply, about 4.5 million square feet, of which 60% is build-to-suits, and the remaining is obviously multi-tenant office. There's only one building currently being under construction today in the airport submarket, which we'll touch on in a minute, which is currently 115,000 square feet and roughly $15 net rent ask today. The airport submarket, as you can scroll up to the top, as we believe is south of the CBD, is an overall area of progressive growth to the south and of the city. Currently, the airport submarket has forecasted rent growth of 9.1% per CoStar. We've conservatively underwritten moderate to inflationary rent growth in our underwriting, which is a conservative assumption that we typically like to do. One, because we like to outperform our base case underwriting, which you see on our screen. Class B rents, as I mentioned, over the last 5 years, we've seen a phenomenal amount of growth. And more importantly, the delta between Class B rents and Class A rents is roughly $10 a square foot, which is a pretty wide gap. And considering our historical experience and overall historical performance of this project, we think Class A rents will continue to be pushed, and B will draft off of that accelerating A rents, and B would continue to improve. I guess lastly, in the area of the south end of Charlotte in the airport submarket, Class B office product rents today or net absorption in the last 2018 numbers was almost 500,000 square feet of positive net absorption. And all classes across this submarket were 800,000 square feet. So that's a pretty compelling amount of demand for this south end of Charlotte. And then lastly, there is in the path of growth, if you see in the key deal points, the spine of the links, blue line, the light rail, you'll see under the key business points in the path of growth, there's various rail line stops going down south spine of the city, which these projects have access to. They're not walkable. The blue line extension, which will be completed in 2000, actually, I think it was completed late this past year, will connect all the way to the University of North Carolina at Charlotte, terminating at their campus. And then lastly, there's a huge redevelopment of the current airport, one of the top 10 busiest airports in the country at Charlotte. There are major renovations going on with the main terminal. They're adding a fourth runway, and all three of these assets are within a 3 to 10-minute drive. So given all these positive attributes, we believe in the limited new supply will continue to show growth and overall rent growth in the airport submarket. So turning our attention to just the capital stack, if you want to scroll down, Andrea.
Slightly. There we go.
There's a senior debt position that you'll see. We'll just scroll back up to the top. Senior debt, you see capital stack, sponsor equity, investor equity is senior debt. The senior debt, I wanted to focus on that particularly because this is a 3-building campus, and how that optionality provides us as an owner to sell off 1 building, 2 buildings, or all 3 buildings at the same time or at different periods of our hold period. We're doing this loan with East West Bank, which is a lender. This will be our third transaction with East West Bank. We've done over $30 million of transactions with East West. This would be our third transaction. We're using the same legal and business team, so we've got a great rapport with East West Bank. This $12 million loan will be a 5-year loan with no extensions. It's prepayable at any time with no fee. It's a 36-month interest-only loan, and then after that, it's 2 years of amortization on a 30-year schedule at LIBOR plus 200. This one loan across these 3 assets is not cross-collateralized. So if we were to sell an asset at any point in time, either Airport Overlook or BECO, pick a building, we're able to release the building at par value, which is 65% of an allocated value to that asset. So there's no issue in terms of releasing each one of these loans as a part of any potential sale, as well as a portfolio sale.
So maximum flexibility for exiting all 3 at the same time or all 3 individually. And just to correct one thing Andrew said, I think he used the word campus, just so everybody's clear, these are not adjacent to each other. They're in the same submarket, but they are not on a campus. So this portfolio, not a campus.
So with that, I'm going to turn it over to Fred to go over more specifics about each asset and some of the downside matrix that we like to look at and just the overall area and maps, et cetera. So Fred?
Great. Thank you, Andrew. Andrea, can we go to the overall map of Charlotte so we can get our bearings? So the airport submarket it's shaped like a cone, starting at the southwest side of downtown, running south along Park Road, which is just east of Highway 77, and west just north of the airport, going all the way to the South Carolina border. As Andrew mentioned earlier, the airport market is the largest suburban market in Charlotte, with roughly 13 million square feet of office, according to CoStar, largely comprised of corporate headquarters, which are serviced by tenants in the neighboring low-rise business parks, such as Airport 3. Over the last 12 months, office rents have grown over 8% in the submarket. The recently completed 485 loop, which is the only major loops circumventing the city, allow tenants to draw their workforce from the executives who live around Lake Norman and South Park, which is just to the east, and worker bees from East Charlotte and South Carolina. And 10 right there is Airport Overlook, and BECO Plaza and Scarlet Oak are just to the south, which if you click on the individual maps, it'll bring you in to see where they are. Andrea, if you could go to the amenities map, please. I think it's further down.
Yeah, right there.
No, further down.
Oh, sorry.
Amenities map. There we go. If you could open that up, please. So the properties are centrally located 5 minutes from the airport and 10 minutes from downtown to the north and South Park to the east in the South Carolina border, which is maybe 5 minutes more, so call it 15 minutes. There are plenty of local food service providers in the immediate area for tenants to grab a casual lunch. And for corporate entertainment, tenants are only 10 minutes from the highest-end Charlotte restaurants in and around the South Park Mall, which the red arrows are pointing towards. Property management will likely bring in food trucks once a week, which has been well received by our tenants in Raleigh. If you'll notice where the arrows are pointing in the South Park Mall, the surrounding neighborhood is Myers Park, which is arguably the most prestigious neighborhood in the city. Houses started at $1 million relative to the average home sale, which is in Charlotte, which is a little over $220,000. Now we're going to go to the floor plans, if you would, please, Andrea. And we're going to start with Vico Plaza. So let's talk about what is going on currently and who's in there. I can't read that. Can you go to the first floor for me, please? Thank you. So Vico Plaza is roughly 61,000 feet, 93% leased. It's home to 16 tenants. The only vacancy is located on the first floor, which has a lease in negotiation, much to the chagrin of our management team, where they were looking to put a management office in there, but I don't think that's going to happen. The latest proposal for that space on the first floor is a 4-year deal, $23 full service gross starting rents, 3% escalations, $16 in TIs, which exceeds our underwriting market leasing assumptions of 5 years, $22.50 starting, 3% bumps, and $40 for tenant improvements. So we're going to do our best to make that deal. DHI is also located on the first floor, and they're negotiating a 3-year renewal at $20 starting rent, which is a little lower than we'd like. However, with the 3% bumps and no TI or abatement, effectively it's much better than what we underwrote. Now on to Airport Overlook, if you would, please. Floor plans. Airport Overlook is a 3-story, 61,000 square foot Class B plus office as well. It's currently 81% leased, home to 6 tenants. There's one 5,000 square foot vacancy on the first floor and one 6,300 square foot vacancy on the third. ACI is on the second floor, and they're not utilizing their space. They're a little over 16,000 feet. We're currently negotiating terms with a new tenant to take the entire suite, which would start November of this year. The latest proposal is 7 years, $22.50 full service gross starting, rent at 3% escalations, 4 months free, and $35 in tenant improvements. This exceeds our underwriting market leasing assumptions that I had for that space, which was 7 years, $21 start, 2.5% bumps, and $35 for tenant improvements. The current proposal effectively outperforms our model and would be a huge win for the entire portfolio. We've paid for a test fit, and negotiations are currently underway. Now on to Scarlet Oak, please. Floor plans. Yep. So Scarlet Oak, as you'll recall, is the single story. It's right across the street from Vico Plaza, 78,000 feet, Class B, currently 80% leased, and is home to 7 tenants. Although there are 3 vacancies, our model conservatively assumes we only lease up one 3,000 square foot vacancy during our hold period. The major tenant, Blue E-Cigs, is not utilizing their space. It's about 12,000 feet. They're currently paying rent, but the space is dark. Our model assumes they break their lease 2 years early. If you look at the rent roll, they are set to expire in 2023. But to be safe, we assume they're going to leave early, and we're leaving ourselves with over a year downtime to release the space in case it takes longer than anticipated. Our general market leasing assumptions for Scarlet Oak, depending on the size of the space, are between $11 to $12 per square foot net, 3% escalations, and between $35 and $50 a foot for tenant improvements and 4 months free. And if we could go back to the deal points section, please. So I think at the very top. So the top reasons that I think we should invest in this are threefold. These assets are best in class, the basis of the deal, and the downside protection. The airport portfolio, as Andrew mentioned earlier, it's unique in that it's Class A amenities, Class A finishes, conference rooms, workout facilities, offered at Class B rates. We believe the value has been recognized by the tenants, as evidenced by the current occupancy and continued leasing activity. The 3 leases currently in negotiation are all outperforming our underwritten assumptions. And my apologies, can you go back to the floor plans? I forgot to go through that, the leases in negotiation. So if we go to BECO on the first floor, please. Thank you. You talked about it. I forgot to talk about Lincoln Electric. So, the 23? Oh, I did go through that. Yeah. Never mind. Okay. We'll go back to, I forgot I'd cover that. Go back to the very top, please. So the second reason is basis. So we're purchasing these assets at 40% of replacement costs. The average recent sales comps for office in all classes in the airport market is $96 a foot, the highest being $230, a little bit over $230 a foot. Average sales price in South Park, as you recall, just to the east, is over $200 a foot with new construction trading above $400 per square foot. Only one new project, Andrew already talked about. It's single-story flex. It's set to deliver in December of this year, quoting $15 net rents. The main competition for these buildings will be the Exchange, formerly known as the Vanguard. It's about 2 miles to the northeast of this project. 14 buildings, 600,000 square feet. Roughly 60% of it's flex, 40% is traditional office. Purchased by an institutional investor in 2018 for $75 a foot. They're putting another $45 a foot in building-level upgrades, fitness centers, conference rooms, outdoor seating, basically everything that we have in these 3 buildings. The $45 a foot does not include leasing costs. So a resale assumption of $128 a foot in 4 years will be less than their basis today. The Exchange is currently quoting $26.50 full-service gross rents for both their flex and traditional multi-tenant office buildings. If you'll recall, our rents in the multi-story office, the multi-story office, 2 multi-story office buildings in this portfolio are between $21 to $22.50 full-service gross, and the Scarlet Oak single-story office building, we're assuming $12 net. Third reason why we should buy this is downside protection. Andrea, if you'll open up the investment package, please, and go to page 12. Great, thank you. Yeah, perfect, okay. If we experience a downturn during our hold period, we feel confident this asset will continue distributing cash even if rental rates fall. Our effective rates are assuming heavy TI packages, which can be adjusted if rates fall. Our risk analysis takes 3 potential factors into consideration: capital markets, which is the first one, rent growth, and space absorption. The corresponding effects of each of the risk factors and their effect on the returns can be seen in the tables to the right. Our doomsday model, which is on the 13th page, if all these bad things happen at the same time, we get a 1-2x equity multiple. We actually get a higher cash on cash as there's less leasing assumed with all the downtime. And with that, that concludes my section of the presentation.
Thank you, Fred. Appreciate that. Andrea, if you could go back to the top of the main web page. Appreciate it. At this point in time, we'd like to open it up for questions, and we'd be happy to field any questions for the balance of the allotted time.
All right, thanks so much, Griffin team. So like the team mentioned, we'll be opening it up for questions. So if you do have questions, feel free to type them into the questions box. I do want to provide an update in terms of offers. So as of right now, let me refresh our page here. We are creeping up close to the funding target in terms of offers submitted, and we've just become oversubscribed. So we currently have 3.15 million in terms of offers submitted with a target of 3.1. So at this point, we've reached the stage of oversubscription. But with that, I would love to jump into some questions. So my first question for the Griffin team, what renewal probability do you use for current tenants in your modeling?
Brad, would you answer that, please?
So over the last 20-odd years, if you average all of our properties in Texas, Arizona, Utah, North Carolina, amazingly, they all average about 66%. So conservatively, we use that number.
Great. And how are your other North Carolina assets doing?
Well, they've exceeded our expectations, but it looks like we need to find a lot more deals in Charlotte.
So we have 3 properties in Raleigh. One of them has already been on a round trip. It's been sold. We sold it actually a year early, and it was a deep value add. It was about 50% occupied when we bought it, and it was actually technically in Cary, so a suburb of Raleigh. And we leased it up to 95%. We sold it in about 2.5, just between 2.5 and 3 years, and had a mid-20s IRR on that property with just under a 2 multiple. The other 2 are performing well. One of them is a mixed-use office over retail in West Raleigh near the Rex Hospital. It totals about, about 100,000 square feet total, I believe.
It is now
with the 4th building.
Yeah.
And it is, the first 3 buildings we bought in that 4-building complex are 100% leased. And then there was a distressed building that was separately owned that we acquired just recently, about a year after acquiring the first 3. And it was about 35% leased. And it remains about 35% leased, but we have quite a bit of activity and expect to have that leased up by the end of the year. So we expect those will be, all 4 will be 100% occupied by the end of the year. And then we have a building also on Glenwood Avenue near the Carolina Country Club that is called Carolina Place. And it's currently 94% leased, and the rents are several dollars above what we originally underwrote.
$5.
Thank you, Fred. $5 above what we originally underwrote. It does have a pending full floor vacancy. There's a tenant that we can't accommodate that needs to grow. They have 1 full floor with us. We don't have any more room for them, and they're going to be moving out to a new construction building in about 9 months. So we will have some availability there, but our expectation is we should be able to backfill it relatively quickly.
Great. So we have a few investors asking about the drop in cash flow in year 3 and 4. So just wondering if you could kind of discuss why that drop occurs, or if you could go into that a little bit further.
Sure, happy to. So what's going on in years 3 and 4, starting with year 3, we've burned through the majority of the $2.9 million in good news from East West Bank. The majority of that coming from we're replacing a roof in Airport Overlook, and we're modernizing both cabs and Airport Overlook. So
elevator cabs. So just to be clear, for those who aren't familiar with the term good news, it's actually additional loan proceeds that are available to be borrowed to be spent on the buildings if and when there are costs associated with new leasing or renewal leasing and or capital expenditures. So what Fred is describing is a $2+ million additional loan facility not drawn and does not have to be drawn. You only pay interest on it when it's drawn, and the terms are the same as the main part of the loan, which is funded at closing. But that loan covers a fair amount of leasing costs that occur in the first 2.5 years.
It's a little over 2 years.
What he's describing is that at the expiration of that, then we're funding leasing costs out of cash flow, and then in addition to that, we've conservatively underwritten a new roof for one of the 3 buildings in that 4th year, I believe.
So, correct. So what's happening in year 4 is, as Edward mentioned, so we've already burned through the good news money by year 3, so year 4 has the same issue. It would be more like a 7% yield. However, what we do in our modeling is we take a trailing 12-month from the resale month and looking at it from the perspective of the next buyer. So I have a $650,000 roof for Scarlet Oak. There's nothing that has indicated that we need to replace it, but given the vintage, the next buyer's likely going to ding us for some value for that. We've assumed the full value plus all the leasing costs for that next year.
So the short answer is there's some capital spending in that 4th year that may not occur. And if it doesn't occur, then the cash yield would be better than what we've shown.
Yep.
Great, thank you. And another investor asked, have you purchased an interest rate collar to mitigate floating rate risk? Why did you not finance with a fixed rate loan?
Great question, and apologies I didn't mention that earlier. It was in my notes, but I just didn't mention it. We are through this East-West loan facility, like a facility we're doing currently in another asset that we're purchasing with East-West as a lender. We're doing what is called a costless collar. It's a hedge instrument where interest rates, if they go a certain degree below or above LIBOR, we have interest rate protection that does not go beyond, say, 5.25% interest and not below 3% interest. Obviously, we're thinking the yield curve is fairly flat and interest rates are staying fairly consistent over the near term. So we do have a hedge in place, and we'll have that in place at closing.
Great. And we have a couple of investors. Sorry, go ahead.
That will be for the term of the loan.
Full term.
Great. We have a couple of investors asking why Griffin Partners is not taking any fees or promotes.
Well, it's not completely accurate to say we're not taking any fees. We are not taking acquisition fees and will not take a disposition fee, and we do not have a promote. That's correct. We do have an asset management fee. It's 1% times investors' contributed capital charged quarterly, so 0.25% each quarter, and we actually deduct it from the distribution in April, July, October, and January before the distributions go out. And the primary reason that we're not taking a promote is because we are determined to build our investor base in partnership with CrowdStreet over this next year or two, and we are offering very favorable terms in order to accomplish that goal. We do have and have in the past done promote structures at the asset level, and we do have a promote structure within our fund, but our view is that a maximum alignment of interest for the time being is dictated by the structure we have, which our promote for our principals comes on the back end of our fund, third fund. We actually are harvesting assets in our second fund, and we will begin harvesting assets in our third fund probably later this year.
Great. And we have a couple individuals asking about the seller of the buildings. Was it the same seller for all of the buildings?
Yes.
Great. And let's see. How do you feel about the 8% exit cap rate assumption? How does that compare to what these properties trade for in a recession?
So we look at the 8% of Our operating expenses, it's really more like 8.25 to 8.5, which would be reported and what a broker would bring to market. So the reported cap rates from these reports that we read are generally inflated the other direction. So we feel very confident on our numbers. An 8% cap rate is appropriate.
And it's also relatively consistent with the comparable trades in the market, subject to that adjustment that Fred mentioned. Also, I just reiterate the last thing we looked at in our prepared remarks was our risk analysis, and one of those three was a capital markets analysis. And in that risk analysis, we assumed kind of an 8.5 cap rate on our NOI, which is probably, to Fred's point, an 8.75 or 9 on a marketed broker package. So there is an examination of what happens if cap rates go up.
Great. And do you know the minimum occupancy for break-even cash flow?
We have to maintain a 1.5 debt coverage through our East-West relationship, and basically it's about a 60% occupancy across the portfolio.
Great. And what is the motivator for the sale from current owners if you're buying below replacement cost?
So, first of all, our fund has a fund life, which is 5 years from the end of the investment period. So 55% of the capital in this deal is coming from Griffin Partners Fund 3. Its investment period ends in March of next year, March of 2020. So that means the fund life will end in March of 2025, at which point in time we hope to have all of our investments sold and harvested at that point. There is, of course, as is typical in these fund structures, the ability of the general partner to extend the fund life at the general partner's discretion for a couple of years, but eventually all of the assets have to be liquidated. And if you look at our second fund, which had 11 assets, the end of its investment period was in December of 2015, which means December of 2020 is the end of its initial life. Of those 11 investments, we have sold and harvested 8, so we have 3 remaining investments in that fund too, one of which is likely to be liquidated here before the end of the year. So our history certainly shows evidence of our motivation and our action of selling these assets when the business plans are complete.
Great. And can you explain what will be the distribution strategy and what is the assumed distribution schedule, including the start?
Distributions will start no later than August 31st, and they'll be made monthly, and they'll be based on available cash flow. And available cash flow includes the NOI of the property less the debt service, less any reserve payments required by the lender, and any potential reserves that we might set aside in addition to lender reserves, just to make sure that we have appropriate funds for any circumstance that may arise. But we expect that to be north of 8% solidly beginning no later than August 31st, paid monthly.
Awesome. Thank you. And I just want to make note here because we've had a couple people reach out asking about the availability of the offering. So we reached a point in terms of offers to where we had to take it down. So we've basically exceeded the funding allocation in terms of offers. So at that time, we don't want investors continuing to submit offers, so it's been taken down at this point. However, we'll continue to, ask questions, as a lot of the investors on the webinar have gotten their offers in. So another question that we have is if you could explain again how the 5-year loan amortizes.
Sure. It's a 60-month loan. In the first 36 months, it's interest only. During the period of that first 36 months, you're paying only interest and we're hedging that interest rate, and the spread is LIBOR plus 200. And then starting in month 37 through 60, the loan amortizes at a 30-year amortization schedule.
Great. And how do you feel about the tenant mix in light of a likely recession during the hold period?
So the mix of tenants is a combination of local and a little bit of national credit. The national credit is likely to perform well during a downturn. The local credit is typically firms that are servicing some of the larger corporate entities in the market, either providing services to or in some cases providing products to. And depending on the severity of the national recession, those tenants can be impaired periodically. We have a history of having been through 3 recessions with our team, and we have a very aggressive approach to monitoring payment histories and credit in the event that there is a recessionary environment. So we're very proactive about managing that. But there's a decent amount percentage-wise of local credit in the tenant base. However, it's a very diverse tenant mix. So the number of tenants is fairly large, and exposure to any one of those local credit tenants is pretty minimal. Did you want to add anything?
Great. All right. And we've got a couple questions here. Is there any possibility for 1031 exchange? How did the areas fare during the last 2 recessions? And we'll let you address those 2 first.
Sure. So the first one is easy, and unfortunately it's no. We don't have the ability to do any kind of exchange on this particular offering. The second question is, Charlotte actually was very largely impacted by the global financial crisis, primarily because its largest industry is financial services. And in fact, the reason that we were not targeting investments in Charlotte immediately after the most recent recession, say in 2011, 12, and 13, is because of concern about the concentration in financial services and whether or not that industry had really completely stabilized and all of the shakeout had occurred. It's our judgment that starting in about 2015 that in fact it really was stabilized. All the regulations that were going to be put into effect by Congress had pretty much been done, and the big banks kind of knew where they stood at that point in time and had right-sized themselves, and there weren't a whole lot of giant mergers or additional layoffs coming down the pike. And that's about the time we re-entered the market in terms of our interest in putting it as a target market and really beginning to look hard at opportunities there. So our view is that the next recession is not likely to have near as much impact on the financial services industry because of the fact that all of the large banks, all the banks period, are much better capitalized than they were heading into the prior recession. The regulatory environment is such that the risks they are taking are much more transparent and manageable. And so while Charlotte still does have a significant exposure to its largest industry, financial services, we think the risk of significant employment shrinkage in that industry is no longer high, and certainly much less than it was in the last recession. So an argument could be made that Charlotte is actually likely to outperform the rest of the larger economy, shall we say, in the next recession because of its exposure to financial services.
Great. And why is being close to the airport versus downtown an attractive option for tenants?
So the discount, as we were talking about earlier, with the Class A and CBD assets is anywhere between 10 and when you get into downtown, $15 to $20 a foot. Rent-wise. So it's a huge value to the tenant that can fly in and out in a day from Boston or New York or San Francisco. They're 5 to 10 minutes from the airport, and they're paying.
So, for example, if you have a financial services firm with offices in New York or Boston, and they put some back office operations in Charlotte, which is a common theme, they can get a value opportunity in the airport submarket with a $10 or $15 a foot discount off of what they pay in the CBD, and the proximity to the airport is beneficial for executives traveling down from those cities in the Northeast.
In Seattle.
Great.
Across country as well, yeah.
All right, another one. Can you discuss any tax advantages that are expected to pass through to investors?
Sure, happy to do that. So we perform cost segregation studies on all of our investments after acquisition, shortly after acquisition, which allows us to front load as much depreciation as is possible. And the result is that frequently, despite having positive cash flow from the investment in the first several years, investors will get a K-1 that will show actually a tax loss. And I guess I should first caveat any of these remarks by saying we cannot provide and do not provide any tax advice. So anybody that is looking for an answer that they can rely upon with respect to this question needs to consult with their own tax consultants and accountants and attorneys. I can tell you from experience, however, that what I said a moment ago is likely to be the case, that you're likely to see cash distributions again first several years well in excess of 8%, and yet show a tax loss in the K-1. Now, there are depreciation recapture rules when we go to sell these assets, regardless of whether we sell them as a portfolio or individually. Some of that depreciation is going to be recaptured in accordance with Section 1231 of the code. So what happens there is that you have a 25% rate instead of a 20% rate on the gains associated with that recapture. The net effect, of course, is a tax deferral, which now that the Fed has restored some time value to money, can be valuable to investors.
Great. And one investor wants to know, once a particular asset is sold, will the proceeds from that sale be distributed without waiting for the other sales?
Yes, absolutely.
Great.
And as I mentioned earlier, considering the loan is one loan, we are able to sell any individual asset at no penalty at the par value of the loan for that asset plus 20%. So if it's a $10 million sale and we have a $5.5 million loan, we plus 20%, which is roughly $7 million, we're able to distribute the difference, which would be $3 million as an example.
Yeah, so just to reiterate, we touched on this earlier, when the question came up about what motivates us to sell, remember that 55%, $3.5 million roughly of the equity invested in this deal is coming from our fund, and our fund does have a preferred return and a promote over that preferred return to the Griffin principals. And the benchmark against which that fund is measured is an IRR benchmark. So we are motivated to get cash back to our investors as quickly as possible. You just don't see it at the asset level. It's embedded in our fund level.
Great. And what percentage of the deal does Griffin Partners have investing cash? Are they on the same terms as the LPs?
Yes, exact same terms, Parvasu, with one exception, and that is the asset management fee. Because our fund investors are already paying an asset management fee inside the fund. So at the asset level, only the CrowdStreet investors are paying an asset management fee at the asset level. And the Griffin Partners Fund is investing $3.35 million roughly, and the asset management fee inside the fund is a similar calculation. It's based on contributed capital, and it's actually slightly higher. It's at 1.25%. But that's because those investors get access to some deals that aren't necessarily offered on CrowdStreet.
All right, great. And we have probably time to take one or two more questions, so I'm going to try and fit those in, but we are at 55 minutes. So we're going to be coming up to a close soon. Let's see. Would participants be subject individually to a requirement to file North Carolina state income tax returns?
No, thankfully in North Carolina we can file an any level return, and we do for our North Carolina properties. Now, again, first of all, we can't provide tax advice, and we do not provide tax advice. So there is an exception to that if investors have other investments in North Carolina that require them to file a North Carolina return, then obviously they're going to have to do that based on those other investments, and we can and do provide a North Carolina K-1 to allow them to do that. But the difference is that the tax will already have been paid by the properties.
Okay, great. And then we'll do this as our last question, and then we'll cover some housekeeping items before we go ahead and sign off. But our last question, does the seller have other Charlotte properties that you are considering for future purchases?
Yes.
All right. Great. Well, thank you to all of the investors who were able to attend this webinar. Do want to reiterate that we were oversubscribed, meaning offers exceeded the funding allocation, so we've taken the offering down. And for those who are in the deal, please allow up to 24 hours for your documents to be reviewed and approved by our team here. After 24 hours, feel free to follow up with us at ir@crowdstreet.com with an update. But as we did receive quite a lot of investments, it will take about 24 hours to review those items. If you do have any other questions, or if you felt like your question was not addressed during the webinar, I will be sending any remaining questions over to the sponsor that can be addressed by them, and we'll be addressing any questions that CrowdStreet can address and sending you answers offline to those. So thank you again, and do you have any last statements, Griffin team, before we sign off?
No, we do not. We thank everybody for their participation and their interest, and we are appreciative of the opportunity to present this to you, and look forward to a successful partnership.
All right. Thanks, everyone, and have a nice afternoon. Take care.